Hello everyone, my name is Reima from the Ohio State University. Recently, Bitcoin is really popular among investors and scholars. Its fast speed and high volatility development brings both opportunities and risks into the financial market. Today, I'm going to briefly talk about Bitcoin's efficiency and its practicality for both arbitraging and risk hedging. Here's an overview of what I'm going to talk about. All data I used is from Bloomberg Terminal, which is a reliable source for financial field. Bitcoin is the first decentralized digital currency, which means it is the only currency whose system is based on neither administrators nor central banks. It's becoming more and more significant as cryptocurrency and worldwide payment methods. Thus, predicting Bitcoin's price trend is more and more important, but it's really difficult. As we can see from the chart, from 2014, Bitcoin price has a scary high volatility. Prior scholars have made many analyses based on Bitcoin price before 2017. Two outstanding recent research are published by Darberg and Arcart. Arcart finds out that the Bitcoin market is in its progress to become more and more efficient in the long term. Darberg figured out that a possible advantage that makes it significant to add Bitcoin in today's rich list of market analyzing and hedging tools. However, the data they used is before mid-2016. There's a high possibility that the degree of Bitcoin market efficiency and its usefulness as a risk hedging tool has changed during 2-year development, which is exactly what I want to explore. First, I will talk about my analysis on Bitcoin market's efficiency. From 2010 to 2014, the Bitcoin market seems not very efficient. In this case, I will examine both the whole period and the sub-period. This is the formula I used to calculate Bitcoin's return. I choose to use natural log of Bitcoin prices, which is the most common method of return calculation. As we can see, data from the full analyzing period shows strong inefficiency. If the market is efficient enough for hedging, investing opportunities should be given from an obvious left bias, as investors could arbitrage from buying low and selling high. But the negative skewness shows a clear large right bias. Yet the standard deviation of the sub-period is very small, showing a signal for efficiency that there's small error between the market price and the correct price, also known as book price in the long term. Besides, the range of the return is smaller than before and has a gentle left bias. Thus, although the Bitcoin market is inefficient in its full history, its trend in becoming efficient is quite strong. Investors can be confident that the Bitcoin market will turn to highly efficient in the long term. Then let's take a look at Bitcoin's practicality. I will start with its ability of arbitraging. Based on the conclusion from the previous section, Bitcoin provides significant opportunities for arbitraging. Yet, this new arbitraging tool has a very small group of oriented investors. It is not suitable for normal individuals and small companies because of the high cost and high volatility. Although there are so many conditions that limit investors' number, the number of investors still keeps increasing worldwide rapidly. Right now, institutions such as Kobe and CME Group are trying to launch futures contracts and ETF funds that contain Bitcoin investment. Those financial products make it easier for institutional investors to either buy or bet against Bitcoin. However, this idea is difficult to achieve. Now I start my analysis on Bitcoin's ability for hedging stock market risks. I run nonlinear regression to S&P 500 index price. As we can see from the chart, the result shows a significant correlation between Bitcoin price and S&P 500 index price because the R-square is really high. Generally, the two prices have similar trends with an approximately positive relationship. The similar trend and high correlation give strong evidence for the fact that the return on Bitcoin is affected by changes in the stock market. In this case, it's not possible for investors to hedge market risks by investing in Bitcoin market. Still, there's a chance for Bitcoin to turn useful for hedging again, since the high correlation mostly results from the data within recent 2 years. I use the same method for testing Bitcoin's practicality in hedging risks within currency market. There's an R-square as low as 6.66% and a meaningful t-value. Thus, the output of the test shows that there's no correlation between Bitcoin price and the DXY currency index price. The non-correlation means that the currency market has no effect on the return on Bitcoin, which creates a possibility for investors who make arbitrage in the currency market to hedge some of the market risks by investing in Bitcoin. In conclusion, Bitcoin's 2-year development indeed changed prior researchers' conclusion. With an efficient market characteristic, Bitcoin market plays a significant and irreplaceable role as an arbitraging method. Also, Bitcoin can still be added to the list of assets to minimize risks for the US currency market. However, future researchers are needed for exploring whether Bitcoin can be practical again for hedging stock market risks. Here's the reference I used for my analysis. Thank you very much.